Something extraordinary is happening right now, and almost nobody is connecting the dots. China, the world's second largest economy, the factory of the entire planet, the nation that manufactures everything from your smartphone to your shoes to the medicines in your cabinet. China just recorded its most severe deflation in over 100 years. Prices are not just falling, they are collapsing. Consumer prices dropped 0.7% in February 2026. Producer prices dropped 2.2%. These are not normal numbers. These are numbers that historically appear only at the edge of an economic catastrophe. And then at this exact moment of maximum vulnerability, the Iran war slammed the Strait of Hormuz shut. Brent crude spiked to $108 per barrel. Oil, the one thing a deflationary economy cannot absorb, is surging. China's factory floors, which were already bleeding, are now bleeding faster. This is not two separate stories. This is one story, and it is the most dangerous economic convergence the global system has faced since the 1930s. Stay with me, because what I am about to show you is not speculation. It is a pattern, a mechanism, a system that has repeated itself with almost identical precision across every major deflationary crisis in recorded economic history. And right now, in March 2026, we are sitting at the exact same convergence point that every generation before us dismissed as temporary until it was too late. Let me show you how this works. Every major deflationary collapse in economic history follows the same four-stage sequence. It does not matter if we are talking about Japan in 1990, the United States in 1929, or Germany in the 1920s. The stages are identical, the timeline varies, the outcome does not. Stage one is always the setup. A major economy builds itself on debt-fueled growth, manufacturing expands, exports boom, credit flows freely, asset prices, property, stocks, commodities rise faster than underlying economic output justifies. The system looks strong, confidence is high, the economy appears unstoppable, everyone believes. The expansion will continue indefinitely because it has continued for so long already. Stage two is the overextension. Debt accumulates beyond what the economy can service. Property prices, the primary store of wealth for ordinary citizens, begin to crack. Developers default, banks tighten credit, consumers, seeing their primary asset losing value, stop spending, businesses, seeing demand weaken, cut prices to move inventory, and here is the critical trap that makes deflation so uniquely dangerous. When prices fall, consumers wait to buy because prices will be lower tomorrow. When consumers wait, demand falls further. When demand falls further, prices fall more. When prices fall more, consumers wait longer. The feedback loop becomes self-reinforcing. And there is almost no tool in the central bank playbook that can break it from inside. Stage three is the external shock. Just as the deflationary spiral is gaining momentum, something hits from outside: a war, a trade disruption, an oil embargo, an external supply shock that drives up the cost of the inputs the struggling economy depends on. At the exact moment the economy has the least capacity to absorb higher costs. This is the trap within the trap, because an oil shock in a healthy growing economy is painful but manageable. An oil shock in a deflationary spiral is potentially lethal. The central bank cannot cut rates to stimulate growth because that risks allowing inflation to surge from the oil shock. It cannot raise rates to fight the oil inflation. Because the already fragile economy would collapse, there is no exit. The policy tools that exist to fight deflation and the policy tools that exist to fight inflation are opposite responses. When both crises arrive simultaneously, the central bank is holding two contradictory prescriptions for the same patient. Stage four is the inevitable outcome. The deflationary spiral and the inflationary oil shock create what economists call stagflation, falling economic growth combined with rising prices. This is the worst of all possible economic environments because it impoverishes everyone simultaneously. Savers lose because inflation eats their Purchasing power, workers lose because economic contraction destroys jobs, businesses lose because costs rise while demand falls, and governments lose because tax revenues collapse at the exact moment spending demands surge. 4 stages, every deflationary crisis in modern history, no exceptions, and right now China is between stage 3 and stage 4 in real time. Let me prove it. Japan, 1990. The most instructive case in modern economic history because Japan was, at its peak, the second most powerful economy on earth. Japanese companies owned half of downtown Los Angeles. Japanese investors had purchased Rockefeller Center. The Nikkei stock index had risen nearly 600% in a single decade. Japanese property values had reached levels so extraordinary that the Imperial Palace grounds in Tokyo were theoretically worth more than the entire state of California. Stage 1 was breathtaking, real innovation, real industrial superiority, real export dominance. Then came stage 2. The debt that had funded the expansion became unmanageable. The Bank of Japan raised interest rates to cool the speculation. Property prices cracked, then collapsed. The banking system, which had used inflated property as collateral for an ocean of loans, found itself holding collateral that was worth a fraction of the debts it secured. Credit froze, consumers stopped spending, businesses stopped investing, deflation set in. Here is the devastating part. Japan tried everything, interest rates cut to zero, then below zero, quantitative easing programs that injected trillions of yen into the financial system, government stimulus packages across 3 decades. None of it worked because once a deflationary psychology becomes embedded in consumer and business behavior, monetary policy loses its transmission mechanism. You can create money. You cannot force people to spend it when they believe prices will be lower tomorrow. Japan's lost decade became the lost 2 decades, then the lost 3 decades. In 2024, 34 years after its peak, the Japanese stock market was only just recovering its 1989 highs. 34 years to recover, an entire generation of wealth-building opportunity consumed by a deflationary trap that the world's best economists could not escape. Check, verified, undeniable. The United States, 1929. The Roaring Twenties were, in the language of our framework, the most spectacular stage 1 in American history up to that point. Technology was transforming daily life, radio, automobiles, electrification. Credit was flowing freely. Stock market valuations had disconnected entirely from underlying corporate earnings. Ordinary Americans were borrowing to invest in stocks for the first time in history. Stage 1 complete, the foundation, while built partly on speculation, felt permanent. Stage 2 arrived quietly. The Federal Reserve raised rates in 1928 to cool speculation. The effect was not a soft landing. It was a trigger. When the credit that had been feeding the expansion withdrew, the asset prices it had inflated could not be sustained. The crash arrived in October 1929. What followed was not a correction. It was a deflationary spiral of a magnitude the modern world had never experienced and has never experienced since. Industrial production fell by half. Unemployment reached 25%. Prices fell so far and for so long that farmers were burning crops because it cost more to harvest them than the market would pay. And then the external shock arrived inside the crisis. The Smoot-Hawley Tariff Act of 1930 raised tariffs on over 20,000 imported goods. Trading partners retaliated. International trade collapsed by 65%. The supply shock of sudden trade disruption combined with the deflationary spiral to produce an economic catastrophe that lasted an entire decade and reshaped the global order permanently. Check, verified, undeniable. Germany, 1923. This example is essential because Germany faced the exact opposite problem simultaneously: catastrophic inflation from external war reparations, which is precisely the dynamic now threatening China from the opposite direction. Germany was already in economic crisis when the external shock of unmanageable Reparation payments drove the government to hyperinflate its currency. The result was the complete destruction of the middle class's savings. People carried wheelbarrows full of marks to buy bread. Life savings accumulated across decades became worthless within months. The political and social consequences of that economic catastrophe directly paved the road to what came next. The lesson history teaches about the intersection of internal deflation and external inflationary shock is brutal and consistent. The human cost is always paid by ordinary people who had no vote in the decisions that created the crisis. Check, verified, undeniable. Now are you ready to see where China is today? Because here is where this becomes not just China's problem. Here is where it becomes your problem. China's deflation is not a recent development. It has been building since 2021. The collapse of Evergrande, the world's most indebted property developer with over $300 billion in liabilities, was not just a corporate failure. It was the first visible crack in a property market that had absorbed the savings of 300 million Chinese families. Property represents approximately 70% of Chinese household wealth. When Chinese property falls, Chinese consumer confidence does not just decline, it collapses, because the asset that represents the primary store of value for the vast majority of Chinese citizens is losing value every month. The numbers are now unmistakable. Consumer prices fell 0.7% in February 2026, the steepest drop in consumer inflation on record for modern China. Producer prices, what factories charge for goods before they reach the consumer, dropped 2.2%. This means Chinese factories are selling their output at prices that are barely covering costs, in some cases not covering costs at all. They are not doing this out of generosity. They are doing it because demand has collapsed and they are fighting for survival. The deflationary psychology that took Japan 30 years to exit has now embedded itself in the world's largest manufacturer. This matters to you directly because of what China actually does in the global economy. China manufactures approximately 30% of the world's goods. Everything that fills your stores, that powers your factories, that builds your infrastructure passes through China's production system in some form. When Chinese deflation forces manufacturers to cut prices to survive, it exports that deflation to every nation that imports Chinese goods. The price pressure you feel at the checkout counter in your city is partly a function of what is happening in a factory in Shenzhen or Guangzhou right now. And then on top of this deflationary spiral, the Iran war closed the Strait of Hormuz. Approximately 84% of the oil that passed through the strait in 2024 was bound for Asia. 84%. China is the largest oil importer in the world. Its industrial economy runs on energy that transits that narrow stretch of water. Brent crude has surged from $72 per barrel on February 27th to $108 today. That is a 50% increase in the single most critical input cost for Chinese manufacturing in 3 weeks. Think about what this means for a factory that is already cutting prices to stay alive. Your energy costs just increased 50%. Your profit margin was already razor thin or non-existent. You now have two choices. You raise prices and lose orders to competitors who are cutting prices, or you absorb the cost and move closer to insolvency. Neither choice leads anywhere good. The deflationary spiral and the inflationary oil shock are now acting on the same system simultaneously. Stage 3 has arrived. Now here is where it becomes urgent for every person watching this, regardless of where you live. China's economic distress does not stay inside China. It never has. The 2015 Chinese stock market crash sent shockwaves through global markets within days. The 2015 Chinese currency devaluation triggered capital flight across emerging markets from Brazil to South Africa, and China in 2026 is vastly more integrated into the global economy than it was in 2015. The supply chain dependence that the pandemic exposed, where a shutdown in one Chinese province could empty store shelves from London to Los Angeles, that dependence has not fundamentally changed. The trade relationships, the manufacturing networks, the commodity demand, that China generates for resource exporting nations around the world, all of it remains in place. All of it is now at risk. Here are the three misconceptions that people always raise at this point, and each one is dangerously wrong. The first misconception is that China will simply stimulate its way out of this, that the Chinese government, which has an authoritarian capacity to direct investment and spending that no Western democracy possesses, will simply mandate growth. This argument misunderstands what deflation actually is. Japan's government stimulated aggressively. For 30 years, its debt-to-GDP ratio is now the highest of any developed economy in the world, exceeding 260%, and it has not escaped the deflationary dynamic. You cannot stimulate your way out of a deflationary psychology because stimulus creates money supply, but it cannot create the confidence that causes people to spend rather than save. When citizens believe prices will be lower tomorrow, no government program changes that calculation. The Chinese government can build infrastructure. It cannot rebuild consumer confidence that has been destroyed by watching property values fall every month for 4 years. The second misconception is that the oil shock will be short-lived and therefore manageable. This argument assumes the Iran war resolves quickly and cleanly, that the Strait of Hormuz reopens fully, that oil prices return to pre-war levels. But S&P Global's analysis published this week shows that even in their base case scenario of short-lived disruption, Brent crude is expected to average $90 per barrel through March, only gradually moderating, and Capital Economics forecasts that even a contained 3-month conflict could push Brent crude to an average of $150 per barrel over the next 6 months. Energy prices at these levels do not just slow Chinese manufacturing, they potentially break the margin structure of thousands of Chinese factories that were already operating at the edge of viability. The third misconception is that this is China's problem and not yours. This is perhaps the most dangerous misconception because it feels intuitively reasonable. China is far away. Their property market, their deflation, their manufacturing crisis, these seem abstract and distant, but global supply chains do not respect geographic intuitions. The goods in your stores are priced in relation to Chinese manufacturing costs. The commodities that China stops buying will fall in price, devastating the export revenues of resource-dependent nations from Australia to Brazil to Saudi Arabia. The financial system that has lent to Chinese developers and corporations is globally interconnected, and the global demand that China has provided, China consuming vast quantities of everything from iron ore to soybeans to luxury goods, that demand is now contracting. When the world's largest consumer pulls back, every supplier feels it. So what does this mean practically? What do you actually do with this information? First, understand the specific inflation dynamics of an oil shock during a global deflationary environment. The inflation you are about to experience: rising energy prices, rising food prices from higher transport costs, rising prices for manufactured goods as Chinese factories are forced to pass on energy costs. This inflation will not be addressed by central banks the way normal inflation is addressed. The Federal Reserve, which just this week held rates at 3.5 to 3.75% and noted that the economic implications of the Middle East are, in their exact words, uncertain, is effectively admitting it does not know how to respond to stagflation. When central banks are uncertain, the inflation premium in hard assets, gold, commodities, real assets rises, because hard assets do not depend on central bank competence to hold their value. Second, understand which assets are most vulnerable in a simultaneous deflationary and stagflationary environment. Long-duration bonds are exposed from both sides. If the inflation from the oil shock persists, bond yields rise and bond prices fall. If the deflationary dynamic in the broader economy prevails, corporate bond defaults, increase. Equities in sectors exposed to Chinese supply chains, consumer electronics, retail, manufacturing face margin compression from both directions, higher input costs from energy, weaker demand from consumers whose real purchasing power is being squeezed. The Dow has now fallen below its 200-day moving average for the first time since June 2025. The S&P 500 is approaching its own critical support level. Markets are on their fourth consecutive losing week. These are not isolated technical signals. They are the market beginning to price in what the macro data has been saying for weeks. Third, understand the commodity split that this specific environment creates. Not all commodities behave the same way in a deflationary oil shock scenario. Energy and agricultural commodities, which are directly driven by the supply disruption, benefit from the scarcity premium. Industrial metals, copper, iron ore, aluminum, which are driven primarily by Chinese industrial demand, face headwinds from the deflationary slowdown in China's manufacturing sector. Understanding this split is not academic. It determines which assets protect you and which ones expose you to an additional layer of risk that most investors are not currently pricing. Fourth, think about geographic diversification of economic exposure with new clarity. The nations best positioned in this environment are those that are energy exporters benefiting from higher oil prices with limited dependence on Chinese manufacturing demand and limited exposure to Middle Eastern supply chains, certain economies. In North America, certain Gulf states that are rapidly diversifying their economic models, select Latin American agricultural exporters. These are the structural beneficiaries of the exact environment that is now forming. The nations most exposed are the large energy importing manufacturing economies of Asia that depend on both Chinese supply chains and Middle Eastern energy flows. Fifth, and perhaps most critically, understand the historical precedent for how long these episodes last. Japan's deflationary episode lasted 3 decades. The Great Depression lasted 10 years. German hyperinflation destroyed an entire generation of middle-class wealth in under 2 years. These are not short-term trading events. They are structural regime changes that reshape the economic landscape for years. The investors and savers who recognized these structural shifts early and repositioned accordingly, reducing exposure to vulnerable assets, moving into stores of value that hold through currency and deflationary stress, those are the people the history books describe as having preserved and in some cases grown their wealth through the transition. The people who dismiss the warning signs as temporary or manageable are the ones history describes simply as having lost. Let me summarize what we have established because I want the logic completely airtight before you close this video. China is experiencing its most severe deflation in modern history. Consumer prices falling, producer prices falling, property values falling, consumer confidence at generational lows. The deflationary feedback loop. Falling prices causing delayed spending, causing further falling prices, is now embedded in the economic psychology of the world's largest manufacturer and second largest economy. At this exact moment of maximum vulnerability, the Iran war has closed the Strait of Hormuz, driving Brent crude to $108 per barrel. An oil shock of 50% in 3 weeks is landing on an economy that cannot absorb cost increases. The policy trap is complete. Rate cuts risk enabling the oil inflation. Rate hikes risk accelerating the deflation. There is no good option available. The global transmission channels are open. Supply chain disruption will push prices higher in every economy that imports Chinese goods. Commodity demand reduction will hurt every resource exporter that sells to China. Financial market pressure is building. The Dow is below its 200-day moving average. The S&P 500 is 4 losing weeks in. Markets are beginning to price what the macro data has been signaling for months. The pattern of deflationary crises combined with external oil shocks has repeated itself across Japan in 1990, America in 1929, Germany in 1923. In every case, the intersection of internal deflation and external inflationary shock produced the worst of all possible economic environments, stagflation, that lasted years, not months, and transferred wealth from those who held vulnerable assets to those who held stores of real value. The question is not whether this pattern is unfolding. The data says it is. The question is whether you are positioned for it or whether you will be the person who says, looking back, that the signals were visible but you were waiting for more certainty before acting. In every historical episode we have examined, certainty arrived precisely when the window for repositioning had already closed. If this analysis gave you a framework for understanding what the headlines are actually telling you, then there is one thing to do right now: subscribe, because the next video in this series goes deeper. We are going to look specifically at what the world's largest sovereign wealth funds, the institutions that manage the wealth of nations, are quietly buying right now as China's deflation and the oil shock converge. We are going to examine which specific asset classes outperformed during the 1973 oil shock and the Japan deflation simultaneously, and we are going to build a precise practical framework for positioning ahead of what the historical pattern says comes next. This is not fear. Fear is paralysis. This is pattern recognition, and the pattern has never been clearer or more urgent than it is right now. The window is open. History says it will not stay open much longer.